The recently passed legislation called the One Big Beautiful Bill Act is going to impact every single person in America in one way or another. Some for good, but some not so good. But for most seniors, it's going to be for good because included in the bill was a $6,000 senior bonus deduction. In this video, I'm going to explain what this deduction is, exactly how it works, and then give you some real-life examples of who qualifies for it and who doesn't. All right, so what we're going to do, we're going to begin the video by just talking about some of the facts surrounding this legislation. I'm going to actually share 8 of those with you, and then we're going to dig into those facts a little bit deeper and explain how they're going to work and some of the implications, and actually then give you some calculations surrounding this legislation, and then some real-life examples. So let's start with the facts. Fact number 1 here is this, that you must be 65 or older at the time of filing to qualify. And so once we've hit 65 beyond, we qualify for this $6,000 bonus deduction. Now, keep in mind, maybe husband and wife filing a joint return, and let's say husband's 67 and wife is 62. You're only going to qualify for $6,000. Both of you would have to be 65 and above to get the full possible deduction up to $12,000. Number 2, the senior bonus notice is not tied specifically to Social Security benefits, meaning you don't even have to be taking Social Security to qualify for this extra $6,000 deduction. Some of you are full retirement age, maybe 67, and you're waiting till full retirement age, or maybe beyond that as you grow that at that 8% amount. We call those delayed retirement credits. So you're going to wait to age 70, but you can still take advantage, providing, of course, your income is within the parameters of this deduction. All right, so you don't have to be taking Social Security to get it. Number 3, this senior bonus is available. Now notice this one, whether you take the standard deduction on your taxes, that's established, of course, by the government, the IRS, or if you choose to itemize, meaning you have different things that you actually can deduct off your taxes above and beyond that standard amount. And so regardless whether I'm taking standard deduction or itemizing them, I still can get that $6,000 bonus if I qualify based upon my income. Number 4, this legislation, now watch this. It did not repeal or modify how, that's the key word here, how our Social Security benefits are taxed. In other words, that formula that we use to determine how much of our Social Security benefit would be subject to income taxes, that formula called provisional income. I'll actually go through a couple examples of that during the video, but that did not change. So the old system is still used for determining how much of our Social Security will be taxed. But what happened was this, rather, how much of your Social Security benefits will be taxed, that could change if you indeed qualify for this deduction. And so there is a benefit, but again, it's not going to be based upon anything with your exact Social Security benefits. It's going to affect your taxable income. All right, and then number 6, and that would be this, when the senior bonus begins to phase out at certain income thresholds. Again, I'll be very specific tonight during the video to show you exactly what these thresholds are. So if we're considered to be high income by these standards, we may not get that. So they have a phase out period, and they actually have a period where there's no possible deduction at all. And I'll explain that in the video. Then number 7 here, the senior bonus is temporary. We wish it was going to be forever, but it's not. It's going to begin this tax year in 2025. So when you file your taxes in the first part of 2026, you're going to be able to take advantage of that. So it lasts for 25, 26, 27, and 28 tax years, and then it will expire unless, of course, Congress decides to continue with that. But it will expire after 2028. And then lastly here, the senior bonus is not refundable. Okay, meaning it only reduces your taxable income. So those that have very low income and pay very low taxes will probably not see much benefit at all from this additional $6,000. Okay, so again, not a refund. All right, that being said, let's take these facts now and let's look at the implications of these. So the first calculation that we're going to look at has to do with on the tax form, and if you're watching this on your phone, you may not be able to see this, but I'll just teach you anyways, and that is this line here, which is line 11. Line 11 is our adjusted gross income. Now, as we look at adjusted gross income initially, this number is not going to include line 6A, 6B, which has to do with our Social Security. So we're going to take all of our income sources first before Social Security, because this AGI is going to be used for a formula to determine how much of our Social Security benefits will be subject to taxes. All right, so our AGI. So let's walk through this together. So basically, this is all of our income but Social Security, which would be what? Any kind of W-2 income, if indeed you're still working. There is the thing called additional wages from a tax form called 8919. Other income that you may have. Notice this. Taxable interest is part of the income. Ordinary dividends, look at this, taxable amount of an IRA distribution. Not all of it, but that portion that is subject to taxes. Pensions and annuities. And again, those portions that will be subject to taxes are going to be included in the AGI. Now, for this first one, we're skipping line 6A and 6B. We're not going to talk about that yet. We'll come back to that next. Now, we're also going to include an AGI for this one, any kind of capital gains that you have, or any additional income, which is on Schedule 1. And so the point is we're going to take all of this, and then sometimes people have some type of an adjustment to their income, and that comes from line 26 of Schedule 1. But the whole point is all of our income with some adjustments, and that then gives us our AGI. So that's the number that we're going to begin with. Again, no Social Security is a part of that, and then that will take us then to another calculation. And so this first calculation is called your provisional income. So that's where this whole process is going to begin. And that is we have to determine what this provisional income number is. Now, I want to clarify something. Some people in this business of taxes will call this actually combined income. Now, normally this combined income terminology is used by the IRS. It's used by Social Security. Those people are in the financial planning world, advisors, accountants, people like that. They usually use the terminology provisional income. And I only mention it because as you read about this, I want to make sure you're clear that these are synonymous terms. Either way, we're talking about the same thing. All right, now, what we're going to look at now as we look at this calculation is line 6A. And this, notice, is your full Social Security benefit. So whatever you're getting on an annual basis, that is going to be put in line 6A. And we'll give you some examples in a minute. The other line that's important, of course, for this is line 6B. And that's the taxable amount. No one pays taxes on all of their Social Security income. We pay taxes on a portion of it or none of it. And I'll show you how that works here in a minute. So we're going to be looking at line 6B. Now, what we're going to do is we're going to use a formula to get from line 6A to 6B. Obviously, a gross income is, Social Security income is on 6A, but we have to get 6B because that's going to affect our adjusted gross income. We're going to come in and add that to it. All right, so this is the exact formula to determine provisional income. That's an important number. You'll see why here in just a second. So how do we get there? Well, we get there by going to line 11. Line 11 is our adjusted gross income that we just saw without Social Security income, plus line 2A. Now, line 2A is referred to as tax-exempt interest. And so this would be for people that invest in municipal bonds. It could be state bonds. It could be U.S. territorial bonds. But the point is, as we invest in these bonds that are munis or state bonds, territorial bonds, they're exempt from federal taxes. But we still have to report that amount on our tax return. Again, we don't pay taxes on it, but it's reported. But for this equation, we have to add that back in. All right. Now, a lot of people don't have this, but if you do, it's because you're investing in those particular bonds. Now, then what we're going to take, notice this, we're going to take 50% of line 6A. And so let's just give you a quick example. Let's say we're dealing with somebody up here that has $30,000 worth of gross Social Security receipts, that are deposited in their checking account on an annual basis. So 50% of that is going to be what? $15,000. Okay? And let's say they have a normal AGI right now. Let's just call it $30,000. All right? So you have $30,000 of other sources of income plus $30,000 of Social Security, but we're going to count half of that. So this person then would have a provisional income of $45,000. Okay? And that's going to matter here in just a second, as you'll see. So we take this chart, and by the way, these numbers have not changed for many years. So we have a single filer, and we have a married couple filing a joint return. Now, if you had a household or you're married filing a separate return, you're going to have different numbers, but the principle is still the same. And so we'll keep it just with these two for examples during the video tonight. And so what we're looking at here is a single filer. So when we talk about what amount of our Social Security is subject to taxes, they give us some numbers. So if we have a single filer that has a provisional income at $25,000 or less, zero of their Social Security income is going to be subject to federal taxes. If they're between 25 and 34, this different amount, which is $9,000, is now subject to 50% of that amount is going to be subject to federal taxes. And then above this, 85% of all the money that's going to be above that will then be subject to income taxes. All right, so we take our provisional income and we apply it to these numbers here to determine how much of that $30,000 benefit is going to be subject to taxes. So let's do just a quick example here. So we know that we have provisional income of $45,000. We know that the first $25,000 is off limits. So we have $45,000. We know the first $25,000 is zero. Okay, so now we have $20,000 left, right? And so we know that right here is only $9,000. So that's going to be $9,000 subtracted. So now we end up with $11,000 here. So our first 25 is zero, so we don't have to worry about that. We have $9,000 here, and so 50% of that would be $4,500. Okay, and then we have $11,000 above, and that's going to be subject to taxes of 85%. All right, and so what we have here, when we look at this $11,000, we would take $11,000, 85%, and that's going to be $9,350. Okay, and so what we have here would be $9,350 plus $4,500, and that's how much of our Social Security income would be subject to taxes. Now, they also give us another number that we can check because it's either the lesser of these two numbers. So this is one number. The other number would be 50% of our Social Security income. So 50% of $30,000 would be what? It would be $15,000. Okay, or the lesser of these two numbers here, which would be what? 13,850. So 13,850 is lower, and so it's not going to be this one, it's going to be that one right there. So this person that had $30,000 of Social Security income plus $30,000 AGI then is going to have to pay $13,850 of their Social Security income that will be subject to income taxes. All right, so that would be on line 6B. It carries down to that AGI line we have, and now we have a new total as we begin to calculate what kind of taxes we're going to have collectively with all of our income. All right, so that is somebody that would be at this amount. Let's give you another example. Hey, if you found this video helpful and you want to see more Medicare information just like it, then go below, right below the video, and you can give us a thumbs up as well as subscribe to our channel. And every time I put a new video, which is about 2 every week, you'll be notified of that video, and others just like you who need this vital information will get it as well. All right, now let's give an example of someone that has a good Social Security income but does not have any additional income beyond that, which is frankly can be kind of common. So let's say with this person, we're dealing with AGI of nothing. The only thing they have is Social Security, but they have a real nice Social Security income. And so let's say they're making $4,000 a month. So that would give us $48,000 for the year. And what we're trying to do is how much that's going to be taxable. And so we have zero AGI. Let's say they have no tax exempt interest. So 48 of that would be what? $24,000. Okay, $24,000. And so let's go back to our chart again. Remember, $25,000 or below, zero of it's taxable. 34,000 here would be 50%, and then above, of course, would be 85%. So we're looking at our provisional income of $24,000 because we didn't have any additional income over here. And so again, that 24 is below the $25,000 number, so pretty obvious. What do we have over here? This is someone that has zero of their Social Security income is going to be subject to income taxes. So as you can see, what this really favors is if someone is depending totally upon Social Security, has very little else, then most of their, none of their income for Social Security is going to be taxable. Okay, now let's look at a couple examples of a married couple filing a joint return. And again, let's say this couple has a decent amount of income outside of Social Security. Let's say they're having $50,000 a year. Maybe this could be some type of pension income, possibly some distributions. Small ones are taken from IRAs or something, and it's $50,000. And let's call it tax exempt interest. Let's say they're making another $2,000 $2,500 off of that. And then both husband and wife are receiving Social Security benefits, and we're saying it's very attractive. They're both getting about $2,500 a month. That's 5,000 times 12. So we're saying their Social Security benefit is up here at $60,000. All right, so let's look at their provisional income. So we got 50 plus 2. 50% of that number, which is going to be what? $30,000, is going to give us then our provisional income. So we have $82,000 of provisional income. Now we're dealing on the married column. So here's the way it works here. So over here we have $32,000 or less provisional income. 0 is subject to taxes. Next number is $44,000 or less. We have 50% of that number is going to be subject to federal taxes, and above, again, 85%. All right, so we're dealing with a provisional income of $82,000. $82,000. So we know the first $32,000 is off limits. So let's just do our math over here. We know that $32,000 is off limits because that's going to be 0. And so now we have $50,000 left. And so we know we have between here $12,000 that will be taxable at 50% of that. So now we have $6,000 in here in taxes. And so we reduce this by $12,000. And that then leaves us with $38,000 balance that's now subject to 85% taxes. All right? So let's put that number in and let's see what this person's tax liability is going to be with their Social Security. So we got $38,000. We have 85% of that. And that's going to be $32,300. $32,300 plus the $6,000 here. Okay? And so that's going to be $6,000 plus, so that is $38,300, $38,300. So again, we take the lesser of two numbers, what this calculation gave us, and then because they're above the $44,000, it would be 85% of what their Social Security income would be. So that's $60,000 times 85%. Well, that number is $51,000, okay? So that's much greater. So obviously we're going to put over here $38,300 of their $60,000 is now going to be subject to income taxes. All right. So that's the formula for someone that has this kind of income. All right, let's just go one other example, and let's keep our Social Security income the same. We're saying husband and wife both getting $2,500 a month. That's going to be $60,000. But these folks don't have really much other income beyond that. Let's say they're drawing just a small pension of $2,000 a month, and so that would give them $24,000 here of AGI line. Let's say they don't have any taxes exempt interest, and we have 50% of that amount. So what do we have here? So we have $30,000. So we have AGI of 24 plus that. So now we're dealing with a provisional income of $54,000. Okay. And so again, we got to put it to our equation. So anything at 25K or, excuse me, anything at 32K or less is going to be 0. In between 32 and 44 is going to be taxed 50%. And then anything above, of course, will be 85%. So we have our we have our 54,000. Okay, let's take out the first 32. It's not subject to taxes. Now I'm down to 22,000. I have 12 in here, right? So I'm going to subtract 12, and that 12 is going to be 50%. So I got $6,000 here, and I've got 10,000 left over. 10,000, and that's going to be at the 85%. So that would be $8,500. So we have $8,500 plus the $6,000. That gives us $14,500 of their Social Security income is now subject to taxes. Now remember, our test, it's the lesser of, would be 85% of that 60,000, which would be a huge number. We looked at that a minute ago. 60,000. 85% would be 51,000, clearly much lower for sure. So this person then would be paying taxes on $14,500 of their $60,000. All right, so that provisional income is critical, and this is the formula that we're going to follow. And again, before OBA even became law, this is exactly the way these numbers were calculated. All right, that brings us then to another key figure, and this is actually our second calculation, and this one has to do all about with line 12, okay? And this would be the standard deduction. Now notice, or if you itemize deductions and you have that on Schedule A, you'd bring this over on line 12. All right, and so this is what we're going to focus on to determine how much of a deduction do we get to take. We know we have standardized. We know that that was expanded by the OBA, and then we also know that we may potentially be able to get this additional $6,000. So let's look and see how that's calculated. So here's how we actually determine the allowable deduction. So let's walk through this together. Now, when it comes to the different filers, we're looking at single, married filing a joint return, head of household, as well as married filing a separate return. And so let's just look at these four numbers. They've all been published. Now, originally, when the government IRS actually gave us what they said the deductions would be for 2025, that number came out at the latter part of 2024. And the numbers they gave us are right here before you. A single filer, that standard deduction would be $15,000. Married filing joint, double, of course. Head of household, $22,500, and separate return, $15,000. And so that's the numbers that were out. But part of the legislation that was part of the One Big Beautiful Bill Act was an increase of 5% to the standard deduction. And so when that passed, that's what happened. So they're calling this an enhanced deduction because of the passing of the bill. Again, it all went up 5%. So you can see the additional amount. Single people got an extra $750. Married, if they both file a joint return, they get $1,500, double that. Household, someone that's a head of a household, again, a little bit more. And so the whole point is this all happened because of the One Big Beautiful Bill Act. All right, now, so this is new. Now let's go and talk just about the original deduction. This has been around for several years. This is an additional amount that as long as you're 65 or above, you get as a senior. All right, and so you'll notice it's $2,000 for a single person, $1,600 per person married filing a joint return, $2,000 again single, head of household, and then $1,600 if you're going to file this a separate return though you're married. All right, so this again existed before, so nothing was changed by the new law at all. Here's what then changed, and they're calling it the senior bonus deduction. And so that's a full $6,000 per person. Married couple, if they're both above 65, gets $12,000. So again, now what we're going to do is talk about how we qualify for this additional deduction, because that is going to go somewhere on our tax return. Now, right now, what's happening is deduction is on line 12. So we don't know if they're going to add a new line to it. We're actually not sure about that. They say this will come out sometime in September when the IRS finalizes how they're going to implement this particular amount, and then what part of the tax return that will appear on. All right, that brings us then to our third calculation here that is important for our numbers, and that is the senior bonus deduction. Who qualifies? Not everyone's going to qualify. Okay, they're just not. And so what we have is we have certain income thresholds. So the question is, what is the formula that will be used from an income standpoint to determine who gets and who doesn't get it? And again, this is going to be a modified adjusted gross income. Now, just keep in mind, the government has several different modified adjusted gross income numbers. If you're on an ACA plan, they have their own MAGI. If you're on Medicare, we have our own MAGI for that as well. So this is the one for the senior bonus. Here's the formula. So we take our AGI, which is line 11. And just so you know, for most of you, this is going to be the same. Okay, it just will be. But if you happen to have foreign income, many times, you can actually, you qualify for an exemption of foreign income. But if you did get a foreign income, you're working outside the country, and though it may have been exempt from your federal tax returns for this purpose, they're going to add that back in. Okay, that's what this means. So foreign exempt income exclusions. You've got to exclude that off your taxes, but not here. Same thing would apply. You're foreign, you live out of the country, you have rent, utilities, different housing expenses. You actually can have an exclusion for that as well. But again, we're going to add that back in if we have that. And again, most of you are not going to have that. And then we have what's called U.S. territory income exclusion. These are people that are bona fide residents of the Philippines or Guam, the Virgin Islands, American Samoa. We have 5 territories. And so if you're a bona fide resident there, then you actually get to, you don't have to pay taxes, U.S. taxes, because you pay taxes where you live. And so you can exclude that. But if you have those that exclusion, again, it's going to have to be added back in. And I'm just sharing all this with you because some people may have this. Most of you are not going to, but the modified adjusted gross income is going to include those. So again, we're coming up with the modified adjusted gross income for the purpose of seeing if we qualify for this deduction. All right, now let's do this. Let's go through now and let's talk about, I want to begin just by talking about a single filer and the income thresholds that are going to be used. So we start off here with $75,000, and again, modified adjusted gross income with this formula. And if we're in this here from 0 to 75,000, we actually get the full $6,000 deduction per person. Right now, then this would be a single filer up to $175,000. Okay. Now this in here is only going to be a partial deduction because now we're in the phase out period, and I'll show you how that works here in just a second. And then if we're above 175,000, then we don't qualify. Okay, so none. There's not going to be any kind of a deduction if you're above the 175 as a single filer. Now for married, filing a joint return, we have different numbers. And so we start here with $150,000. And again, if I'm in between 0 to 150, I get the full deduction. 150 to 250,000. I'm going to get the partial deduction. It's going to be phased out. I'll show you the formula. And then again, if I'm above 250, married filing a joint return, no deduction at all. Okay. All right. So now let me give you some examples real quickly. You can kind of see how this phasing out formula is going to work. So let's keep it simple. Let's say that I'm a single filer, and let's say I make $20,000 above that. So I'm actually at $95,000. And so the formula is this. For every dollar that we're above, we lose 6 cents. So it's basically 6%. All right, so I'm above $20,000, and so 6% of that would be $1,200. So the full bonus is $6,000, but again, I'm above $20,000, so 6% that'd be $1,200. So instead of getting the full $6,000, they're going to give me a $4,800 deduction. And again, we don't know on what line that's going to appear, but you definitely would get that amount because you can't get the full amount. Okay, now let's just look at one other one just real quickly. Hey, if you come to a place where you know you're going to have to make some Medicare decisions pretty soon, the best way to do that is to click up here in this right-hand corner, and you'll have an opportunity to be able to book a call with one of our Medicare guides. All the guides around here I have personally trained, and they truly are professional. They'll answer your questions, and they'll show you different Medicare options to make sure that you're confident in the decision that you make. All right, so let's say we're a married couple, and we make $300,000. No deduction, that's clear. But let's suppose we're a married couple filing a joint return and we make $200,000. Well, we're clearly in the phase out period, but we're still within the range where we can get some kind of a deduction. And so I'm above by $50,000, and I'm going to lose 6% of my, so that would be what, $3,000. So full amount was $6,000. I'm going to lose $3,000, but I still got a $3,000 deduction on, again, line 12 or wherever they decide to put that in. Again, so if I hit the phase out, that's how it's going to be calculated. If I go beyond that, then it's going to be zero, of course, deduction. All right, so now let's bring all these different deductions together to see how much we'll qualify for. So again, this is that enhanced deduction with that 5 additional % added because of the recent legislation. It went from 15 to 15,750. That original deduction of $2,000. And then there is the senior bonus, that's $6,000. Of course, we don't know what line, again, it's going to appear. But if indeed I was within that threshold, those income thresholds below $75,000, I actually can get a full deduction on line 12 of what, $23,750. Much higher. We picked that $750 and we picked up $6,000. So great benefit in that. Married filing a joint return. Again, originally after the enhancement, $31,500. Each of you we're seeing are above 65, so we got $3,200 there. Just because of age, and then we got the full $12,000 again because we were below the $150,000 modified adjusted gross. So now we got that line 12 sitting at $46,700. All right. So what's the impact of this going to be from a practical standpoint on our taxes? We'll look at that next. So my first example is going to be a single filer, and again, this is before the legislation passed. Let's look at how this is going to work. So we're just giving some hypotheticals here clearly, but we're saying we have line 11 AGI, and now this includes our Social Security income and all the other source of income. So this is the full recalculated adjusted gross income. And so before OBA, that we would have qualified as a single filer of having $17,000. Now, listen, if you itemize, that number could be, you know, $35,000. It could be whatever with your itemized deductions, but I'm just using the standard for the sake of simplicity for the video. So we're going to obviously take $70,000 minus $17,000 deduction, and then that's going to give us taxable income of $53,000. So what I'm going to look at next is we're going to take that and we're going to apply that to the tax tables for 2025 and see what we're going to owe. Okay, so we're at $53,000, and so these are the tax tables that we're going to be using for 2025. And so $53,000 puts us right here, okay? We had 53K, so we're going to be right here. And so the first up to $11,925 is going to be taxed at 10%. Then the difference up to $48,000 is going to be taxed at 12%. And then between 48 to 53, which is a little bit less than $5,000, is going to be taxed then at 22%. So when we combine these together, the different marginal amounts, here's what we're going to have. We have taxes that would be due of $6,574. Okay, and this would be before the legislation passed. Now let's look at what happens to that same amount. AGI, again, $70,000, but now this is a different. Why? This is someone that was single and qualified for the additional $750 and for the additional $6,000. So now we get to subtract a larger amount, and then that's going to give us a taxable income, less of course, and then we're going to take this and apply that to the same charts to see what our taxes would be due, and then how this legislation actually helped us financially. All right, so we have $46,250. And what you're going to notice is that $46,250 is going to put us in this range here. So again, the first $11,925 taxed at 10%, and then everything in between $11,900 up to that number there taxed at 12%. All right, so what happened? Because of the legislation, we're not going to have any income that's going to be taxed at 22% because we have less taxable income because of that additional $6,750 deduction. So now our tax due would be $5,311. So again, we saved about, what is that, about $1,200 less in taxes that is in your pocket just simply because of the passing of that legislation. All right, now let's look at a married filing a joint return, and let's see some of their numbers. All right, now let's look at some examples of those that are married that are filing a joint return. Again, before the legislation passed, and I'm going to use an example of someone that has line 11 says AGI of 100 grand. And prior to the legislation passing, that person would have had $33,200 in deduction, $30,000 standard, extra $3,200 because we have both a husband and wife that are above 65. And so we would subtract that number, of course, and that's going to give us taxable income of $66,800. So let's look at what our tax bill would be prior to OBA. All right, so now we're talking about a married filing a joint return, and we're over here, and we are at $66,800. All right, and so the first $23,850 is just going to be taxed at 10%. But the difference between that and that, which is what, about $43,000, is going to be taxed at 12%. Okay, so what are we going to owe with these marginal rates? Our tax bill is actually going to be $7,539. Okay. But after legislation passed, that's going to improve. Again, we're going to use the same number, 100,000 AGI. We're going to subtract now a larger amount. Why? You can see because we each got the $6,000 standard deduction, we are below the threshold of $150,000, and we got that increased amount as well, from the additional amount in OBA, that extra 5%. So now we have $46,700, and so our taxable income is going to move now down to $53,300. So what is that? About $13,500. So let's see what our tax bill will be now. All right, so with $53,300, we're still going to be right in here. So we got $53,300. Again, the first $23,850 is going to be taxed at 10%. The difference between those two is going to be taxed at 12%. And so because of OBA, now we have a tax bill of $5,900. So again, you can see that's about $1,600 that we have additionally in our pocket because of the passing of the legislation. All right, so as you can see, most of us ought to be excited about this legislation passing because there's going to be some additional money in our pocket because our tax bill is going to go down. Thanks so much for watching.